Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
A byproduct of the financial crisis of the 1990s, pension reform had the backing of both the BJP and the Congress, the two main political parties of the country. While NDA implemented it in early 2000, Congress gave it statutory support after coming to power later. But now, it seems, Congress and some other parties want to turn the clock back. 4 states under their rule have already switched to the old pension scheme, and the parties are using it as a political tool to gain power in other states too. While this may prove to be good politics, is it good economics? Let's find out.
After Rajasthan, Chhattisgarh and Jharkhand, another opposition-ruled state has now decided to implement the old pension scheme. On Saturday, the Aam Aadmi Party-led government in Punjab notified the old pension scheme. However, there is no word on the date of implementation. Congress, which is in power in Rajasthan and Chhattisgarh, where the switch to the old pension scheme has already been made, has now promised to restore it in poll-bound Gujarat and in Himachal Pradesh, where elections have just concluded. The old pension scheme, or OPS, was discontinued in 2003 by the then NDA government. The National Pension System, or NPS, was introduced for central government employees and covered all new recruits joining the service, except the armed forces, from the 1st of January 2004. All the states also shifted to the NPS, except for West Bengal. The NPS was born out of the fiscal crisis of the late 1990s, when pension payments had been growing at an explosive pace. The real and projected increases in longevity had also made the old system unaffordable. At the end of October, the NPS had 2.3 million central government and 5.9 million state government subscribers. There were also 1.6 million and 2.5 million subscribers from the corporate and unorganized sectors, respectively. Amid populist promises of restoring the OPS, voices warning of the consequences have also emerged, and they cannot be ignored. Comptroller and Auditor General of India, Girish Chandra Murmu, and Pension Fund Regulatory and Development Authority Chairman, Supratim Bandyopadhyay, have reportedly said that reverting to the old pension scheme could pose a fiscal risk for states. The old scheme puts the burden of employee pension on the state, while the new system sets contributions from the employer and employee. Under the new system, returns are market-linked. Why are these officials worried? In July, an article by RBI researchers on the condition of state finances warned that the adoption of the old pension scheme was likely to benefit the current generation at the expense of future generations. Punjab, Rajasthan and Jharkhand were among the 10 states that the article flagged for having unsustainable debt and being fiscally vulnerable. On an average, Punjab, Rajasthan, Jharkhand and Chhattisgarh spent 2.3% of their state gross domestic product on pensions in 2020-21. That was higher than the national average of 2.1%. The RBI has said that by 2029-30, Punjab, Jharkhand and Rajasthan would end up spending nearly 3% of their GSDP on pensions. Reverting to the old scheme will lead to more government spendings as employees under the new system begin to retire in 2034. Coming behind Bihar and Assam, Punjab and Jharkhand spent more than 40% of their own tax revenues for pension payments in 2020-21, while Rajasthan spent more than a third of its revenues. Chhattisgarh spent slightly less than a third. On a worrisome note, the tax revenue growth in Punjab, Rajasthan, Jharkhand, and Chhattisgarh is slower than that of revenue expenditure. These states could be heading for financial pain. According to their latest budget figures, the four states will spend more than a quarter of their funds to support pensions in 2022-23. Calls for reverting to the old system aren't just limited to select states. A federation of central government employees' unions has reportedly written to the cabinet secretary demanding the old pension scheme be restored. Ajay Shah, a researcher at Pune International Centre, has said that while there has been no gain from the NPS reform so far with regard to the pension expenditure of states, without the NPS, the share of such expenses in total state revenue expenditure will keep growing for decades. Shah said that in contrast, redemption was on the horizon for the union civil pension expenses and for states that were still in the NPS. According to Shah, the gains from NPS will start reflecting in about 17 years. Pension expenses as a share of total expenses will stop growing at first and then gradually fall to zero. Business Standard also spoke to another expert, economist Rajiv Kumar, about the implications of reverting to the OPS.
I see it as a backward step because we know from past that the old pension scheme creates unfunded liabilities and therefore creates a fiscal burden for the next generations, the quantum of which we do not know.
However, there is another side to the OPS debate too. Economist Pranab Sen says that the findings of his work for the central government on the issue of pensions was that as long as the real growth was above 4.5% and could be sustained, the OPS would also be sustainable. Sen does caution that this growth cutoff figure cannot be generalized to each state. He also adds that much will depend upon the number of government employees relative to the GDP of the concerned state. But he says that that cutoff is reasonably easy to calculate if a call can be taken on the future growth prospects of each state. According to Sen, the fiscal implications of reverting to the OPS scheme will not be disastrous because of the dramatic shift towards contractual government staff who are not eligible for pensions.
The entire arithmetic has shifted in favor of the old pension scheme.
The concern is that reverting to the old pension scheme would turn the clock back on reforms that were hard won in the first place. Editorials and columns across the board have said that parties championing the old scheme are trying to earn political capital by doing away with economic prudence. However, calls for the old system could also be an indicator that the state is not able to provide adequate social security, even when it comes to the creamier layer of the populace. Going ahead, perhaps a balance should be struck between the aims of fiscal prudence and welfare before taking a call on pensions.
Politics, it seems, also came into play at the recently concluded climate summit in Egypt. It relegated the realistic climate goals to the backseat and put several developing countries like India in a tight spot. So will India gain from the newly established Loss and Damage Fund? Our next report answers this and more.
The 27th UN Conference of Parties on Climate Conservation came to a close on Sunday with a hard-fought deal to create a Loss and Damage Fund or LDF. The fund will help poorer countries being battered by climate disasters. The LDF is being seen by many as a major victory. Ulka Kelkar, Director of Climate at World Resources Institute India, says,
all in all, I would say that the Loss and Damage Fund was something which India expressed solidarity with other poor developing countries. And it was a sign of the unity of the G77 group, the group of 77 developing countries, that this fund became a reality at this COP. At the beginning of this COP just 2 weeks ago, the rich countries were not even wanting to put it on the agenda to even discuss. And so it is quite a victory that by the end of it, a fund was created.
Final details on the LDF were, however, missing, especially in regard to the funding. The official UN statement pointed to the institutional arrangements of the Santiago Network for averting, minimizing, and addressing loss and damage associated with the adverse effects of climate change to enable its full operationalization. Not many rich countries supported the need for the fund, but several developing economies, especially African and South Asian nations, clamored for it. It was only the European Union that made an extraordinary intervention on the penultimate day of the negotiations, agreeing to provide financial help to poor countries facing climate extremes. Though India supported the final implementation plan, its key demand to include all fossil fuels for phase down was not considered. The Indian delegation, citing the 6th assessment report of the Intergovernmental Panel on Climate Change, said there is a need for a phase down for all fossil fuels in the context of a clean energy transition. Harjeet Singh of Climate Action Network International explains.
India placed a very specific demand that in the final agreement, we should include all fossil fuels, which was supported by a number of developing, especially vulnerable, as well as a few developed countries. But at the same time, we saw that while Europe, UK, and US played lip service to that demand, but the reality remains that back home, they have been expanding their fossil fuel investments. Also in the context of Russian war in Ukraine, where we see Europe in particular investing for fossil fuel expansion in Africa. And we also see UK issuing gas licenses. And US has been the biggest investor on oil and gas in 2022. So I would not call their support to India's call as a serious one.
Most importantly, the agreement from the United States and some other rich countries to sign the proposal comes with the caveat that contributors to the fund will be expanded beyond the developed world. For India, this development is objectively a net negative. Firstly, there is no reason to support that India, although one of the greatest victims of climate change, will be selected as the recipient of any loss and damage money. The Indian economy is too big for it to be considered. Secondly, there is apprehension that this financing will come at the cost of other forms of climate or development finance, of which India is currently a recipient. The agreement specifies that existing funding arrangements can be repurposed for loss and damage payments, and this threatens flows to India. Moreover, COP27 has pushed a decision on receipts and who pays for the fund down the road to COP28. Even as the agreement proposes a transitional committee to make recommendations on how to operationalize new funding arrangements, the promised $100 billion annual funding by developed nations is yet to become a reality.
What we don't know, of course, is how much money will come in. Some countries have pledged to it. For example, Scotland, Denmark, Austria have made pledges for loss and damage. But it, of course, needs to be much more. And developed countries have been reluctant to now put this issue into the discussions for the post-2025 new climate finance goal. That is, $100 billion that they promised long ago has not come. But going beyond 2025, they don't even want to talk about loss and damage. In fact, they're turning the tables on countries like China, India, Saudi Arabia, and saying, you're rich countries now, you should also pay for loss and damage.
However, Singh points out that this should not be seen as a net negative for India.
It was a demonstration of the power of unity at this COP. Starting with COP26, we have seen the group of G77 in China stayed together and put forth its demand on setting up a loss and damage fund. And that led to this success. And India played an important role. All developing countries are eligible, one. But the first right over loss and damage fund belongs to small island states, vulnerable countries such as least developed countries, as well as Africa.
The establishment of a loss and damage fund is seen as a major victory for India at the COP27 and sends positive signals regarding its diplomatic relations with the G77 and China when it comes to climate issues. However, the fight is not over yet. India will look to strengthen several aspects of the agreement, especially in terms of funding requirements and the accountability of richer nations. For now, the LDF is a reason to celebrate.
Back home, India has decided to remove export duty on steel and steel-making raw material. It was levied 6 months ago in a bid to bring down inflation. While industry has welcomed the move, analysts do not see any benefit in the near term. What is making experts cautious on the move, and how will stocks of related companies be impacted? Our next report does a deep dive.
Over the weekend, the government rolled back export duties imposed on steel and steel-making raw materials, which it had imposed 6 months ago to bring down inflation. The centre reversed export duty on iron ore with grades lower than 58% to nil from 50% earlier, while export duty on iron ore with grades higher than 58% has been reduced to 30% from 50% earlier. Export duty on pallets has been rolled back to nil from 45% earlier, while export duty on pig iron, hot rolled or cold rolled alloy and non-alloy flat steel products of 600 mm or more in width has also been slashed to nil as against 15% earlier. The government has also reinstated import duty on coking coal, ferronickel, coke and semi-coke. Analysts feel the move is sentimentally positive and may push up stock prices in the near term.
The government has, on November 18th, rolled back the export duties on steel and steel-making raw materials, which it had levied on 22nd of May to preserve the higher domestic supplies and control rising prices. Now with the rollback on export duties, we believe the price of iron ore and steel intermediaries are expected to rise, and consequently the stock prices of mentioned company can also rise by 5 to 15%.
With the imposition of duties in May this year, domestic prices fell sharply, putting significant pressure on exports of iron ore and steel products. Indian steel exports, for instance, dropped a steep 53% to 5 million tons in the first half of FY23, as compared to 11 million tons in the same period last year. Exports of iron ore and pallets, meanwhile, stood at around 7 million tons, down sharply by 63% in H1 FY23 from 19 million tons last year. Flat steel exports dropped by around 44%, while long steel witnessed a drastic fall of 69% in the period under review. Domestic steel prices have corrected by 25% in the last 6 months, as against global price correction of 25 to 35%, on the back of weak demand in China and macro headwinds in the Western world. Analysts, however, highlight that as domestic prices continue to command a 6 to 7% premium to import parity prices, exports of steel products may remain unattractive. Given this, ICICI Securities believes the benefits of the move are likely to be marginal and perceives it as a valuation re-rating event rather than an earnings upgrade trigger. It has raised its valuation multiples by 10% each for all ferrous companies, including Tata Steel, Jindal Steel and NMDC, factoring in profitability estimates in pre-export duty scenario. On the bourses, shares of Godavari Power and Ispat, Prakash Industries, Jindal Stainless, Sarda Energy and Minerals, NMDC and Steel Authority of India gained more than 3% in the intraday trade. In comparison, the benchmark Nifty and Nifty Metal Index declined up to 1% during the day. That said, from a long-term perspective, analysts believe global steel prices could be bottoming out as most Chinese producers have started making losses. They expect demand to improve from FY24 onwards, which will help steel stocks to stay afloat. As per JM Financial, The rollback of export duty will likely aid export volumes in the long term given low base, finished steel inventory buildup, and improved competitiveness of India versus Asian countries post rollback of export duty. While we do not expect a significant impact on steel realization, pellet exports are likely to pick up post rollback of export duties. Today's stock markets will sway as per global trends amid lack of domestic triggers.
The government, meanwhile, came out with a revised version of the Personal Data Protection Bill last week. Its introduction for consultations in the public sphere comes at a critical juncture in India's journey to become a digital economy. While the finer points of the bill are being debated, there are key terms used in it that should be known by us all. Today, let's examine 4 such key terms. The 4th iteration of the Data Protection Bill, or the Digital Personal Data Protection Bill 2022, is in the public domain now. The government wants feedback from people before moving ahead and tabling it in the parliament. The bill introduces the concept of fining data owners or data principals for some offences. It also has provision for high penalties on data processors or fiduciaries for offences on their part. The draft bill fills some significant gaps too. For example, it requires data fiduciaries to notify data principals in case of a breach. But what do terms like data principal and data fiduciary mean? Data principal is any individual whose data is being collected, stored, or processed on any digital platform. If the individual has not completed 18 years of age, his parents or lawful guardian would be the data principal. Data fiduciary can be any website, app, or even a small restaurant, which with the consent of data principals, collects and stores their digital personal data. The draft defines data fiduciary as any person who alone or along with other persons determines the purpose and means of processing the personal data. The fiduciary is also responsible for complying with the provisions of the bill in respect of any data processing done by it or by another data processor on its behalf. Imagine if a person shares his data with a website for booking a flight. The person entering the details is the data principal, while the website becomes the data fiduciary. Another term is significant data fiduciary. The central government may notify any data fiduciary or class of data fiduciaries as significant data fiduciary. Significant data fiduciaries have been prescribed additional obligations such as appointing data protection officers and independent data auditor. The criteria for becoming a significant data fiduciary is based on the volume and sensitivity of data, risk of harm to the data principal, potential impact on the sovereignty and integrity of India, risk to electoral democracy or security of the state, and public order, among other things. Last but not least comes consent. A person may process the personal data only following a freely given, specific, informed, and unambiguous indication of the data principal's wishes. It has to be a clear affirmative action that signifies agreement to the processing of her data for the specified purpose. The draft also has a provision where the data principal is deemed to have given consent in exceptional cases like health emergencies, court orders, and investigations by enforcement agencies. On or before requesting consent, a data fiduciary shall give an itemized notice in clear and plain language, containing a description of the personal data sought to be collected and the purpose of processing such personal data.
The nation's trusted bank, SBI, the banker to every Indian.
But there are apprehensions that the new draft continues to enable the government to collect personal data for practically any purpose, leading to fears of mass surveillance. Hopefully, such concerns will be addressed in the days ahead. That's all for today. Catch the next episode of The Morning Show tomorrow. Bye-bye for now.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.